I just can't believe this. And I thank Stephen Feldman so much for writing this, because this is coming from a Wall Street, a mainstream Wall Street guy that was working, right from Goldman Sachs. Today, I want to go right to the goldsilver.com news page, and this featured article here, I want to point that out. Why Goldman Sachs is mistaken about gold. And this is by my friend, colleague, and business associate, Stephen Feldman. And as a former partner of Goldman Sachs and current gold industry executive, now, Stephen spent a few decades in with the Wall Street elite. He really knows that sector. He came from Goldman Sachs, and it came as no surprise when dozens of customers and colleagues reached out to me this week to get my take on the latest research note from Goldman Sachs's Investment Strategy Group, ISG. In the note, ISG responds to a number of Goldman Sachs's wealth management clients who had inquired about adding gold to their portfolios during these unprecedented times. And these are unprecedented times. This has never happened in all of history. We have a huge percentage of the world's population invested in paper assets, and those paper assets were all blown into hyperbubbles by the world's central banks. In short, Investment Strategy Group stated that Goldman Sachs does not recommend gold as a strategic asset class in a well-diversified portfolio. I find this, I love what Stephen wrote here, but I find Goldman Sachs's stance just unimaginable. Gold is money. Stocks are something else. Gold is a store of value. It's the ultimate form of money. Actually, gold and silver are the only forms of money. Everything else is currency. Unlike stocks, gold is not supposed to be an income-producing asset or a dividend-generating security. Therefore, comparing gold to stocks is akin to comparing apples to oranges. I'd call it comparing money to oranges, because the stocks being oranges, gold being money, because people say, well, you can't eat gold. Well, you know what? You can take your money and can buy more oranges later. As Investment Strategy Group points out, gold is more appropriately compared to the US dollar. Like the US dollar, gold is a medium of exchange that is accepted around the world. Like gold, the US dollar pays no dividend. Well, take a couple $1,000 and an ounce of gold, stick them in a drawer for a decade, and come back and see how much stuff you can buy with the proceeds. That US dollar is probably headed towards zero. And in fact, over and over again, I see currencies where they will make a certain bill no longer legal tender, where you can't go and they actually just make them trash. They decide this is no longer currency. I went to Jamaica once. I'll show a picture of it in some future video. And when I was coming back, the British $20 pound note, they were no longer accepting the old version, only the new version of the British pound. And I see this country after country will change their currency periodically. And the biggest difference between gold and the US dollar is that unlike US dollars or any other fiat currency on the planet, the supply of gold is limited. Yes. On April 6th, 2020, the Financial Times released a projection that puts the difference between gold and the US dollar in stark relief. The projected Fed balance sheet will increase $5 trillion to $9 trillion by the end of the year. Now, I want to point out, actually, that last September, the Fed's balance sheet was at $3.77 trillion, and now it's going to be over $9 trillion. So it's even greater than this $5 trillion. But, that's an increase. You're talking about more than doubling by the end of this year. So just 7 months ago, $3.77 trillion. That balance sheet figure in and of itself is nearly as large as the value of all the gold that exists in the world. Now, I want to remind you that he's just talking about the Fed's balance sheet, not including the Fed, the European Central Bank, the Bank of Japan, the People's Bank of China, the central banks of Australia, New Zealand, and every other advanced economy in the world that is currently they're hyperinflating all of their base currency supplies all over the planet. And so if you include that, then all of the world's gold is valued as a fraction of what's happening across the planet as far as the expansion of the central bank's balance sheets. Moreover, the Fed will continue to set or drive interest rates to zero. Consequently, gold will likely maintain its multi-millennia status as the only form of money that maintains absolute purchasing power over time. Well, this is what makes gold money and makes everything else currency. It maintains its absolute purchasing power over time, over long periods of time. So I probably would have put the period right there because it's the only form of money, period. As demonstrated in the chart below, gold will likely outperform all major fiat currencies as it has for the past 120 years. So this chart goes back 120 years ago to the year 1900 and shows the Reichsmark, which went to zero in World War II, and then the Deutsche Mark spliced to the European Union and as it continued in the European Union, and then spliced to the euro. And then we've got the US dollar, the pound sterling, and the Japanese yen here. So all of these major currencies going to zero. Investment Strategy Group's argument number one against gold is not a reliable inflation hedge. And they contend that we do not expect inflation to increase in any meaningful way when the U.S. and other economies recover from this pandemic. Now, first, we're going into severe deflation into this pandemic. It'll probably last a little bit after the pandemic because it changes people's psychology, and everybody is going to be scared, and they're going to save. Episode 7, Hidden Secrets of Money, if you haven't watched it yet. Nevertheless, the long-term inflation is difficult to predict, especially when the global economy is in the midst of a dramatic transformation. And this is the greatest transformation that has ever happened. And you are going to see this short-term severe deflation, a stabilization, and then after the pandemic sometime, there will come a point where some of that currency that is created during this deflationary period starts to come out of hiding from people's savings. And when it does, we're going into a big inflation, potentially a hyperinflation. Putting aside for a moment the risk of short or long-term inflation, the question mark remains, is Investment Strategy Group right? Is right about the relationship between inflation and gold? The historic record provides the clear answer. Gold outperforms rising inflation. Gold even outperforms periods where a fear rather than any reality of rising inflation exists. And Investment Strategy Group admits that gold does have an attractive risk premium above inflation to warrant an allocation, but then it says that that's negated, the slight edge is negated by the storage and insurance fees. And Stephen points out, as somebody that was in that industry for more than 2 decades, as a Wall Street veteran, I got a chuckle out of that line. If the Investment Strategy Group is going to base its aversion to physical gold investment on storage fees, then I would be remiss if I did not point out the myriad of fees that are loaded into most investment choices. Let's assume that a hedge fund does, in fact, hedge risk, a dubious claim for many hedge funds, which are merely leveraged long equities. In other words, they take out futures and options to give them leverage to the equities, so they usually perform in multiples of whatever the equity does. And they're long equities, betting that they're going to go up. But that leverage also cuts in the reverse direction. When the S&P goes up 1%, your investment might go up 3%. Same thing happens in reverse. Then the hedge fund investors are paying 2% annual fees. That's your fee for a hedge fund. Whether you lose or whether you win, you lose money, you still have to pay them 2%. Plus, if you do win, they're going to take 20% of the profits. And that's not just a huge multiple of gold storage costs. It's a multiple of multiples. I mean, gold is very inexpensive when you store it properly. Goldsilver.com, our storage fees, if you look at them, it's an absolute fraction of what these fees are in standard investments. The result of a long-term study shows that the gold price has historically risen during periods of high inflation, and the higher the inflation, the more gold rises, and here's the chart that shows it. And the argument on number 2 is that gold is not a reliable hedge against deflation or a downdraft in equities should economies fall into a recession. And so when they talk about a downdraft in equities, since World War II, these are the 4 worst bear markets of equities. So 72 to 74, the stock market, they've got it here at 49. There was actually a 50% retracement from peak to peak. And then this is the 1987 stock market crash. The NASDAQ and .com, or .bomb as I like to call it, when that bubble popped. The global financial crisis of 2008. And the average was 37% loss for the stock markets. 10-year bonds gained 11.7, but 3-month treasuries lost 1.5. So if you had sort of a diversified portfolio of bonds as a percentage of your diversified portfolio that had a bunch of stocks as your protection, you may have made a 6% gain, something between the 1.5% loss and the 11% gain, 5-6%. Against gold's 40% rise, almost 40.5% rise as an average. And without exception, gold did rise on all of these. And when it was in a bull market, the only time that, here gold was experienced, it was in its secular bull market, but it was in its cyclical bear within the secular bull. So it only went up 16%. But here, 126% during this market crash. That's some spectacular performance. I expect that that's more like what gold is going to do this time around. And here they've got a chart of how it performs during recessions. And in 5 of the 7 recessions that have happened since 1965, gold has offered spectacular performance during these recessions. So it's a good protection during those downsides. Argument number 3, Investment Strategies Group reports that some clients have asked why we don't prefer gold instead, giving a lingering uncertainty around the virus. And they base their prognostication. Our year-end S&P 500 price target implying a 20% gain from current levels. I don't know when they wrote this, but maybe they're talking about the current levels right now, which is possible. If the Fed just starts injecting currency directly into the markets, the markets could go up 20%, but watch where gold does it compared to an 11% advance for gold based on their forecasts. I don't know what GIR is, but based on their forecasts. Now, I just don't think they're taking into it. They're looking at this in a historic perspective, not in the perspective that the Fed's balance sheet is going to grow, that they're going to print currency. It's going to be injected directly into the markets and stuff. The printing currency scares people into gold. It scares them into safe haven assets. While Investment Strategies Group prediction may come true, the historical record as set forth in the chart below informs us that gold has meaningfully outperformed the stock market over the past 20 years. Gold certainly outperformed the stock market since the beginning of 2020 and since March 1st, 2020, and since last week. So for the century, for the year, for the beginning of March and the beginning of the week, it has outperformed the stock market. Simple fact is that gold has outperformed equities in the short run, in the long run, bear markets and bull markets. Not bad for a fringe asset. Thank you, Stephen. This chart, though, shows 425% gain for gold, 149% for the Dow, and for the S&P, 121. So you've got to take more than 25% off of the Dow. Now, I am going to update this chart because it's lacking a little bit of information. As of today, 510% for gold, and that chart didn't have the market crash in it, and so it's barely above 100% for the Dow. Take something off of that for the S&P, and you've got less than 100%. Adjust it for inflation, and you're barely above water. Here, your purchasing power may have gone up 50% for this entire century, 2 decades. Your purchasing power being invested in taking this roller coaster ride of stocks, you may have increased your purchasing power by 50%, where with gold, you would be up 4.5 times purchasing power. So, Investment Strategies Group concludes that a tactical allocation to the S&P 500 is a far better long-term use of a client's risk budget. Risk budget. You've got to remember this word, risk budget, because there's going to be a chart later that I'm going to introduce. And so they're saying, take your risk budget and plow it into the S&P, which is also betting that stocks are going to go up. I just can't believe this, and I thank Stephen Feldman so much for writing this, because this is coming from a Wall Street, a mainstream Wall Street guy that was working, right from Goldman Sachs. But what about a client's non-risk budget? Why wouldn't Investment Strategies Group consider foregoing some incremental projected returns for real downside protection? Are we really having all that much fun on the roller coaster of equities as it lurches toward the next crisis? Thank you, Stephen. If not, then note that gold has served as a far superior hedging asset during periods of crisis. As shown in the chart below, gold provided a stronger hedge than Treasury bonds in 9 of the 11 major crises. And here is gold versus the S&P and Treasuries during crises. So you've got the S&P 500, U.S. Treasuries, and gold, and all of these different crises. And if you notice, there's only a couple here where gold was minus. And so the average here, you've got stocks minus almost 20%, U.S. Treasuries up almost 4%, but gold up almost 7% during all of these crises. There's just no evidence for this mainstream Wall Street dialogue that gold is this lunatic fringe investment. It's one of the best performing assets that there is. Conclusion: portfolios are stronger with gold than without it. And if you back test this with portfolios, it clearly shows that a portfolio with gold outperforms portfolios without gold. 20-year study below takes a 60-40 split of stocks and bonds in a portfolio with equal amounts by adding increasing percentages of gold. And the result shows that a portfolio with 10% weighting to gold outperforms those. Now, this 10%, this is something in the bull market of the 70s. From 1970 to 1980, no Wall Street mainstream advisor, nobody was saying, put 10% gold in your portfolio. Nobody was saying that until 1979, when gold had just blown the doors off of everything and stocks were going sideways but losing tremendous value to inflation all throughout the 70s. So stocks were going down in value. Gold exploded. Best performing asset of the 20th century. And silver was actually better performing, but precious metals, best performing assets. And right at the end, and then in the 80s, they started, in the 80s, when the bear market started in gold, all these professionals started recommending a third of your portfolio, 25%, 20%. And as gold kept on going down for 20 years, it went down in price. It went from 850 down to 250, brutal bear market, 20 years long. And during that period of time, at first they were recommending these huge allocations, and it went down and down and down and down. And after a while, it's just a 10% weighting for gold. And then they got to 0%, but they weren't recommending any gold when gold finally bottomed at 250 and started increasing. They only started recommending 10%, but no more than that, once gold was up close to $1,000 or over. And then Jim Cramer jumps on board and starts recommending buying gold when it was $1,900 an ounce, and then stops when it goes down. You want to protect yourself during these long-term trends by having a greater allocation to what's going to outperform the other things. And so this is based on up to a 10%. So I want to show you something that Jeff Christian of CPM Group. Now, Jeff doesn't like me very much. He considers me a lunatic conspiracy theorist nut, and I don't deal in any conspiracy theory. I only deal in conspiracy facts, stuff that I can prove. And that's pretty much my track record. You can go back as long as I can support everything with data, everything that I have said. But what Jeff came up with here is that a portfolio with 27 to 30% of its assets in gold had the best risk-reward ratio in the years from 1968 to 2017. So this covers both the bull and the bear markets. And what he discovered, so this is how much risk you're introducing, and this is how much return you're getting, the reward. So this is a chart of risk-reward. And with no gold, as you add gold, your risk is reduced and your reward is increased. And it reaches like an equilibrium here, but this is actually the best place to be. But that is with the big bear market from 1980 to 2000 within there. If you strip that out, I'm sure that this curve looks more like this. If you look at my portfolio, I'm way up here with gold and silver, and then some cryptocurrencies, and I've added recently just a couple of stocks, but my portfolio is probably on the order of 70% precious metals, because I know what it does in bear markets and bull markets, and in a bear market I might reduce it to this. If I thought that gold and silver were going to go down, I might reduce it to this. In a secular bear, the market from 2011 to 2015 was a cyclical bear inside of a long-term secular bull market. So it's just this short-term correction. It was a short-term correction that lasted for quite a few years, but still, it's a correction. Bottom line, gold offers resilience. Like most Americans, I'm an optimist, and that optimism allows me to hold a healthy allocation toward equities in my portfolio. But when it comes to protecting myself from the downside of equities, I stand away from many of the worn-out and overused narratives espoused by some of my former Wall Street colleagues. I didn't achieve a 10% allocation of my portfolio all at once. I legged in over a decade. I accepted less risk in exchange for a better night's sleep. Thank you very much, Stephen. Now, a decade after my first investment in physical gold, I'm better off than I would have been had I used that 10% allocation for stocks, hedge funds, or private equity. Excellent. And absolutely so true. As I have explained above, an allocation of physical gold in one's portfolio provides many benefits, but ultimately provides protection and resilience. It's time to rethink portfolio allocation and discover how gold can both protect and enhance wealth while helping investors to weather inevitable economic crises. And they are inevitable. They always happen. Something happens. History has been whispering this very thing in our ears for thousands of years, even if Goldman Sachs' investment strategy group hasn't been listening. Thank you very much, Stephen. Excellent article. Chart of the day. This is from my coming book, The Great Gold and Silver Rush of the 21st Century. And what I've done here is I had my researcher and chart maker, Alan Hibbard, take the current bull market and the previous bull market of the 70s and take them from right when they began. And you measure a bull market when it hits its ultimate bottom. The bear market went from January of 1980 all the way to 1999, and in 1999, gold put in its low. 2001, it put in another low that was $3 higher than this low. So that is the beginning of this current bull market. And in 1970, that was the beginning of when gold left $35 an ounce. That was the beginning of that bull market. And so you've got the previous bull market on the gold time scale, and then this green time scale is the current bull market. Time scale and amplitude scale. And what I've had him do here is compress the time scale by a factor of about 2.5, and then the amplitude scale is also compressed until the two peaks lined up. What I did was I had him line up what a technical trader would call, this is the A wave, the B wave, and the C wave of a Elliott wave analysis. And you line those two peaks up before it goes into its cyclical bear or short-term correction. You've got to work off all of this, getting overbought and so on. And it's scary. Mark Twain said that history doesn't repeat, but it rhymes really well. And this is just scary how well it rhymes. However, the bull market of the 70s, where gold hit $873 in January of 1980 on the Chicago Mercantile Exchange in intraday trading, that was not during a full-blown currency crisis. The dollar did not die or change into another form of the U.S. dollar. It had changed form in 1971, but when we went off of Bretton Woods and it became non-gold backed, that's a different dollar than before that. But now we are probably going into a currency crisis. I don't think this is going to take until 2024, and I actually think that up 36 times, or a peak of $9,000, the more you study this, the more you come to the conclusion that this could be an absurdly low price of gold in the future, and I just don't think it's going to take until 2024 anymore. So that's the chart of the day. Moving on, I want to welcome the almost 1,100 new subscribers. Thank you very much, and make sure you share these on Facebook and Twitter. We greatly appreciate it. Viewer feedback. Hi, Mike. Doesn't it make sense to wait until gold and silver are at blood in the streets prices? If we're going to go into a U-shaped recovery, can you please help the herd understand why it shouldn't wait for the dip? Well, yes. First of all, blood in the streets, that's the general economy. It's going to be blood in the streets. The prices for gold and silver when there's blood in the streets are already going to be astronomical. But if you're waiting for gold and silver to drop to blood in the streets prices, they're not. They're going to do one last pullback, I believe, but that's the pullback for the gold and silver IOUs. It's the spot price of fake paper gold and silver IOUs that they write on the commodities exchanges that establishes that spot price. It's not going to be real gold and silver. What's going to happen most likely is that the spot price will drop, but the premiums are just going to expand to absorb all of that, and the real physical is going to cost you as much, if not more, than it does right now. As gold and silver head north, when all the billionaires come in and try to buy gold, which they can't at these prices, if they try to get a healthy allocation toward gold, and they will, what's going to happen is they're going to be taking 400-ounce bars and stuff off of the commodities exchange, and the price on the commodities exchange might go down, but the bars that you can't get a hold of, the 1-ounce bars of gold, the 1-ounce coins, the silver eagles, all of this stuff is going to become unobtainium, so they will change from gold and silver to the element unobtainium, and that will make them unaffordium. Once they become unobtainium, everybody's going to try to buy them when they can't get them, and they become unaffordium. Can you please help the herd understand why they shouldn't wait for the dip? Well, that's it. The physical probably isn't going to be going through that dip. If you're going to wait for the dip, you're waiting for SLV and GLD and some other derivative of gold and silver. You're not waiting for real gold and silver. Thank you very much. Frodo says, I go to goldsilver.com every day instead of Drudge. Thank you and your guy. My guy is Cameron, by the way, my best friend for more than 50 years. Please comment on Harry Dent's video yesterday about falling gold prices. He's in your Hidden Secrets videos. Thanks again. Well, in those videos, Harry and I agreed to disagree about gold. We both believe we're going into deflation. And that video was made when everybody, all the analysts were screaming inflation. Nobody was saying deflation except for myself and Harry. And but we disagreed about gold. He thought the deflation was going to be a long grinding deflation or permanent. I thought the deflation would be this short-term bounce into a huge inflation or potentially hyperinflation. and I still believe that. And by the way, he made a bet with Jeff Clark, our senior precious metals analyst at goldsilver.com, that gold was going to fall to $750 or something like that. I can't remember the price that Harry picked, and Jeff bet him an ounce of gold against that, and Harry eventually paid him. So Harry has been saying that gold was going to go down for years. I think when it was $400 or $500 an ounce, he said it was going back to $250 an ounce. When it went up to $1,000, he said $750. I don't know what he's saying it's going to go down to today, but he's been raising his downside target as gold keeps on going up. The spot price could fall. Go and try and get a real ounce for that price. It's not going to happen. The Mentat. The most important thing to remember is that inflation is not an act of God, that inflation is not a catastrophe of the elements or a disease that comes like the plague. Inflation is a policy, and he's quoting Ludwig von Mises. And thank you very much, because inflation is a policy, and right now it's the policy of every central bank on the planet. And the only way to protect yourself from their policy is to buy something real. That means productive farmland or precious metals or potentially cryptocurrencies. They may do very well, even though they're virtual, they are limited, and that makes them protected against fiat currencies that are unlimited in quantity. Finally, we got the quote of the day. And make sure that you get my book and share it with everybody you can. Send it to all your relatives. It's a PDF. Just email it to everybody. Gold is the money of kings. Silver is the money of gentlemen. Barter is the money of peasants. But debt is the money of slaves. Thank you very much, Norm Franz. He wrote a book called Money and Wealth in the New Millennium, and that was released in 2002 when gold was under $300 and not a popular asset. So thank you very much, Norm Franz. We'll see you next time. Thank you for watching.